Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. As you probably know, yesterday the Fed increased its short-term rate 75 basis points. It was the single largest increase in almost 30 years since 1994. And then what did the stock market do? Well, it shot higher. And that had some folks scratching their heads wondering what exactly is going on. And in fact, a viewer named Mike sent me this email. He said, "Can you do a video on stock valuations for idiots?" He said, "I watched the Fed news and commentary all day. The experts on CNBC were begging for a substantial interest raise by the Fed. They received a 75 basis point rise, and future raises are promised. The stated purpose was to reduce consumer demand. All indexes then substantially went higher. I don't get it. How does reduced consumer demand correlate to an increase in equity values?" Well, Mike, it's a great question. I'm going to do my best to answer it. Here's what we're going to do. First, we're going to look at what happened yesterday. Then we're going to look at just stock valuations generally. How should we think about the value of really any business, public or private? And then I'm going to do my best to explain the craziness yesterday. And then finally, I'm going to tell you why it's absolutely and completely irrelevant to us as investors. And I'm actually going to show you why it's irrelevant. So those are the four things I'm going to try to do. Let's start with what happened yesterday. And let me show you a chart from the Wall Street Journal. So as we know, the Fed raised its rate 75 basis points. So by the way, we will see the first thing that happens is credit card rates go up. I've already received information from credit card issuers that have already raised their rates. Savings rates will go up. They're more slow to respond. Prime lending rate will go up. But you can see this was yesterday's movement, and you see the NASDAQ, the S&P, and the Dow. And they announced the rate at 2 o'clock. So that's right here, 2 p.m. Eastern time. And the first reaction, well, there was sort of a positive reaction, but then it went negative, but then it went positive. So I guess the market was digesting the news. It wasn't sure whether this is good or bad. First, it was a little good, then it was bad, then it was good, then bad, good, bad. But at the end of the day, I guess it ended up a positive in the market. So I guess the market was happy with what happened. So that's what happened yesterday. Now, before we get to the why, let's talk generally about stock valuations. And here, I think it's important to distinguish the day-to-day changes in the value of a public company versus long-term value. And long-term, what matters are profits, the cash flows that a company generates. We often think about them in terms of dividends. That's a portion of a company's profits they pay to investors. But the profits a company makes, including the profits it keeps, they call it retained earnings, are just as important, right? Because that's money that a company can put back into the business, invest it back into the business to hopefully grow profits in the future. By the way, no different than, say, if you and I were in the real estate business and we had some rental units and they made some money, and rather than taking it out, we decided to invest it back into our business, maybe to buy additional rental units or to improve the rental units that we own, all with the idea of increasing future profit. It's no different at Berkshire or Apple. They're just working on slightly larger scales, but it's the same concept. So what drives long-term, I think, real business valuations are cash flows. That's all that matters. Now, in the short term, all kinds of things can cause the stock market to fluctuate. The president of a country can say something. The Fed can say something. There could be some consumer survey that's taken, and that could affect it. Of course, there could be a conflict, military conflict, that could cause the market to move one way or another. But in the long term, ultimately, what drives valuations are cash flows, and that's one of the reasons Warren Buffett has said that in the short term, the stock market is a voting machine. It just, whatever happens that day that catches someone's attention on Wall Street that moves the market. But in the long term, it's a weighing machine. And what it's weighing are cash flows. And that's what drives long-term business values. Again, no different with a private company. It's just that private companies, you don't see their valuations go across the ticker every Monday through Friday. And so it doesn't seem as volatile as public companies do. But again, long-term, it's cash flows. That's what matters. And certainly things that can affect cash flows, you would think, would drive valuations. And that gets us back then. This is to the third point in Mike's question. He would say, right, Rob, I get it. Profits, that's what matters. But boy, the Fed's trying to reduce consumer demand. So wouldn't that reduce profits? So that gets us to, why did the stock market go up? And first of all, let me say this is at best a guess. And I know in financial news, pundits will, you'll see them, on TV telling you why this or that happened. And they may say it with all the confidence in the world, and they may be very smart people, but understand at the end of the day, trying to explain market moves minute by minute or day by day is a best guess. But here's the best guess, is that yesterday, yes, the Fed raised it 75 basis points. First of all, that was not a surprise. I actually was predicting 50 basis points. Shows you what I know. But the market was betting on a 75 basis point increase. So the market wasn't surprised by what the Fed did. That's the first thing. But I do think at least one possible explanation was that in the Fed chairman's comments, talking about future raises, they didn't rule out a 50 basis point increase the next time. They didn't rule out a 75 basis point increase either. But I think the market liked that. They thought, okay, maybe the next rate won't be as high as we thought it might be. Maybe it'll be just 50 basis points. And I think there was some comfort. Now, that may not seem like much to you. Frankly, it doesn't seem like much to me either. But I do think there could have been some comfort there. There might also, and this is, I don't think as many folks were talking about it, but I wonder if this might be true as well. There might have been some comfort in the thought that the Fed is willing to do what it takes to fight inflation. Yes, that reduces the demand, or that's in theory what it will do, and that could hurt profits at least for a time. But I think the market could have been thinking, look, if we get inflation under control, there might be a slight dip in demand for some period of time, but then we'll be able to continue the growth that we've been seeing. At least that might be the hope. Now, there could be other explanations. And by the way, again, I want to stress, this is just, I'll call it a best guess as to why the market reacted the way it did. Now, fourth and final point, why is it totally irrelevant? Well, I could just say, look, we need to focus on long term. What the market does day to day truly is irrelevant, and that is absolutely true. But I want to show you something. I'm recording this at, let's see, it's 6:43 a.m. Eastern time the next day, right? So remember, the market was up. Apparently, they liked something the Fed did or said, and the market was up. Well, what's it doing this morning? Well, let's take a look at the futures. Here we go. There's our fearless leader right there. And S&P futures are right here. They're currently a negative 2.24%. The Dow a negative 1.8%. The NASDAQ a negative 2.75%. And for those keeping score at home, the Russell 2000 a negative 2.36%. And at this point, you're saying, Rob, I don't think the markets have a clue what they're doing. Exactly. That's absolutely true. The markets are wrong each and every day. They do their best to self-correct each and every day. They always get it wrong in the short term. That's not a bug, that's a feature. That's how the markets work. Each day they try to get closer and closer to what the valuation of any asset is. Each day they're absolutely wrong. And one day they can be up 2%, the next day they can be down 2%. That's likely what we're going to see today. But for all I know, by the time 4 p.m. rolls around, the market could be up for the day. Who knows what's going to happen today? That's just the nature of the beast. Our focus as long-term buy and hold investors of stocks is to look at the long term. Think not even years, but decades. That has always been my focus. I think it's the right focus. No different, by the way, than how I would think about a private business that I might own. I would be totally unconcerned about the day-to-day fluctuations of the value of my business. It's not publicly traded, a private business, so I wouldn't even know what those fluctuations are, even though they would fluctuate just as much as a public company. There's just no way to see the fluctuation. There's no way to see the volatility, and that's exactly how we should look at publicly traded companies. Well, Mike, there's my best answer to what I think is a very, very good question. I hope that helps. If you guys have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.